Okay, so good afternoon and welcome to today's webinar on top 10 tax saving tips. And today's webinar is being presented by Paula Wheatley of Charnwood Accountants and Business Advisors. For those of you who haven't joined our webinars before, my name is Aaron and I'm an assistant consultant at DG Legal. The slides from today's presentation will be sent over to you tomorrow, and a recording of the webinar will be available on our website. So if we do run over and you need to leave at any point, you'll be able to catch the rest of it at another time. We are in webinar mode, so that means we can't see or hear any of you. So please use the Q&A function so that Paula can answer any questions that you have at the end of the presentation. And on that note, I would like to hand over to Paula.
Thank you very much. So thank you all for joining me today. So this webinar is aimed at business owners, whether that be self-employed or limited companies. So I'll just take a moment to give you a bit of background to us as a firm. So we formed in 2004 and started working with solicitors quite quickly. We utilised a tax saving model which generated in excess of £5 million for clients. Unfortunately, this model is now closed, but during that time we did build a large number of solicitor clients which covered a vast range of legal sectors, and so we created Charnwood for Solicitors. I am one of 5 partners at Charnwood and I head up the solicitors department, and my main role here is in supporting business owners, including equity partners in solicitors practices, to make commercial decisions to increase their wealth, happiness and ensure they remain tax efficient. So hopefully today's webinar will give you some food for thought on ways you can save some tax. And I'll just start with a really boring disclaimer before we get stuck in. So I just wanted to let you all know that these tips are based on legislation at today. There is an autumn statement coming out on the 22nd of November, which could mean some of what I've said might change, although largely what I have here should be okay. But I will mention it as I go along if there's any bits that I think may come up in the autumn statement. Okay. So this isn't a tax tip, but just something I want to start with because it's something I get asked about a lot. And that is, when I'm a new startup business, should I go self-employed or limited? Now, historically, the answer to that question was always set up a limited company as you'd save tax. It was sort of a no-brainer. However, things have changed in recent years because corporate tax rates have increased, and so have dividend tax rates, and they keep going up as well. So all individual circumstances do need to be reviewed before you do make a decision, such as the benefits of the limited liability status that comes with having a limited company, regardless of what tax savings we've made. But if we put it simply and look at it purely from a tax perspective, if you need every bit of profit after tax that your business makes for you to live on, then you're probably better off being self-employed. Whereas if you make profits in excess of your living needs, then you will probably be better off as a company. So just to put some numbers to that so that you can understand what I mean. Say you make £200,000 a year of profit, but you only need £100,000 to live on. So as self-employed, you're taxed personally on that whole £200,000, and you're taxed on it ultimately the highest rates of tax because you move through the levels, and then you'll have surplus cash sitting there after you've paid your tax because you didn't actually need all of it to live on. For a company, the profits are all taxed at corporate tax rates, but then you're only taxed personally on the money you draw from the company, which would be via a salary or dividend. So if you only choose to draw 100 grand and leave 100 grand in, you would defer any personal tax on the undrawn profits because they're being retained in the company. So you're making a tax win on that 100 grand that you didn't need to draw. So any new startups really need to just ask themselves 2 questions. 1, what do I need to live on? And 2, how important is that limited liability status that comes with being a company to me? And that should help you towards making a decision. So of those comments there, I don't really foresee any major changes in the autumn statement because they've already done quite a lot of tax hikes recently. But I'd be more worried about what might happen if we have a change of government, such as if Labour comes in on the next election. Some of this could change then, but I can't see it changing dramatically. Okay, so let's move on to some actual tax saving tips then. So our first one is pensions. So whether you operate as self-employed or a company, pension contributions will save you tax. So we'll start with how this will work for a limited company because it's different under each business setup scenario. So as a limited company, you'd usually follow a model known as small salary and dividends. And what that means is you'll take a salary of somewhere between £9,000 and £12,000 per annum, and then you take the rest of your income as dividend. Now, pension contributions are restricted to your net relevant earnings. So if you were to then make a personal pension contribution, you'd only actually be able to contribute that salary figure that you take, so between £9,000 and £12,000, because dividend income doesn't count as relevant earnings. So this is why we tell our clients to take an employer pension contribution instead from your limited company, because then you're not restricted by that relevant earnings because the company is doing it for you as your employer, not you as a person. So that pension contribution would show as a deduction from your profits, and so you then obtain corporation tax relief. So depending on the level of profits that you make, your relief will be between somewhere of 19 and 25% based on what the current corporation tax rates are, because as of 1st of April 23, they're on a sliding scale upwards from 19 to 25%. So at the moment, you can put £60,000 per year as a maximum pension contribution. So the maximum corporation tax saving you could make is £15,000. But also, if you had a pension scheme in existence in previous years but didn't contribute, then you can make use of those prior 3 years unused allowance for pensions. So for example, in 22-23, the annual allowance for pensions was £40,000, and in 23-24, it's £60,000. So if you didn't make any contribution towards that 40k in the prior year, technically this year you could put £100,000 in, being your current year 60,000 and the previous year's 40,000. So there's opportunities to make some quite big tax savings and get some good chunks of money out of the company. So the annual allowance, as I said, this year is £60,000, and that only increased to that from the 1st of April, which was as a result of the last budget. So we don't know how long that would be in place, and historically it's always been £40,000. So it's worth keeping an eye on and maybe making the most of that higher maximum £60,000 figure while it's in place. So just to give you an example of how it would look, so we've got a company here that's made £360,000 of profit. So I'm going to show you what their tax looks like with and without a pension contribution. So with a pension contribution, you've got your £360,000 of profit. We deduct £60,000 from the profit because that's the contribution we've made. So now our taxable profit is £300,000. If this company paid the maximum 25% corporation tax rate, their corporation tax would be £75,000. The non-contribution column, you can see, so their taxable profit is still £360,000, so they're going to pay £90,000 in tax. So you can see here they've made £15,000 tax saving and also managed to get £60,000 out of the company to go into your pension pot to help save for your retirement, rather than you drawing it out and paying tax on it to get it into your hands. So it's a good benefit to do this. So let's look at it from the self-employed perspective now. So the only difference here is, rather than the contribution being deducted from your profits, as I showed in the previous example, it instead extends your basic rate band. So for you, what that means is after your first £50,000 of income, you pay tax at 40%. But if you make a pension contribution, that £50,000 band where you start paying that higher tax rate, it gets increased by the amount you contribute. In addition to this, the extension of the basic rate band would also help you retain some of your personal allowance. So when your income goes over 100 grand, you start to lose your personal allowance. But that, again, the band is extended, so you get a greater time frame before you start losing that allowance based on your pension contribution. The only thing from a personal point of view when you're making pension contributions that you need to be aware of is when your income hits 260,000, the amount you're allowed to contribute is restricted. And then once your total profits are over 360,000, you're only allowed to put in £10,000 a year. So it's just be aware of what your income level is before you start considering any lumpy pension contributions. So somebody's just asked me a quick question. Can I make a lump sum pension contribution to my employee? So the answer to that is yes. As an employer, you can make a pension contribution to your employee. So for example, you might have an employee who's got 50k income and you're going to give them a bonus of £10,000 because they've done really well in the year. But they come back to you and say, well, actually, if you give me that, I'll be a higher rate taxpayer, so I'll lose a lot of it. And also I'll lose my child benefit because my income's gone over 50 grand. So that doesn't really help me very much. So then you could say, well, actually, would you like me to put it into your pension for you as an employer pension contribution? So that's absolutely fine. You can do that. In addition, you would also make an employer's national insurance saving because you're not giving them the salary. So you might, if you're a nice employer, want to pass that saving on to your employee as well. So that's also worth considering. So just to put some numbers to the self-employed calculation for you then, just bear with me 1 second. There we go. So this is the example for self-employed people with and without. So this self-employed person has profits of £100,000 and they want to make a contribution of £25,000. Now, when you do a personal pension contribution, the government top up that pension by 20%. So the grossed up value, so that £25,000 actually turns into a figure in your pension pot of 31,250 because you get that government top up. So with this pension contribution then, you can see here the basic rate band for tax purposes, 37,700. Then you add to that the 31,250 gross pension. So you pay more tax on your profits at the 20% rate, less at the 40% rate. So overall, this person will pay £21,182 in tax. If they didn't make the pension contribution, you can see here that the 37,700 doesn't change, so that's still taxed at 20%, but they pay much more of their income at the 40% tax rate. So their tax ends up being 27,432. So by making that pension contribution, they've saved £6,250 in tax, got 31,250 into a pension and actually made an extra 6 grand or so out of it because of the government top up. So you do really well out of doing personal pension contributions. Somebody's asked about SIP payments and going down in value. Now, I'm not a financial advisor and bar our regulations, I'm not allowed to comment on performance of investments. So all I can tell you is from a tax perspective. There's timings you can think about when to put your money into pensions and things. And if you did want a conversation with a financial advisor, I'd be more than happy to put you in touch with some referrals of ours so that you could look at how they're performing for you. Okay. Okay, so next up is electric cars. So this is mainly aimed at limited companies because self-employed people can drive any vehicle they want to, and they can either put all of the vehicle costs through the business and then you do something called a private use adjustment to deduct your private motoring basically from your profits, or you can put through mileage claims for your business mileage. So it's up to you as a self-employed person how you do that. So from a limited company perspective, what you can get is 100% first year allowance on brand new. So what I'm saying here is if you bought outright a £50,000 brand new electric car, must be fully electric, you can make a corporation tax saving of up to £12,500. And that's because you get 100% tax relief in year one. So really the true cost to you after that tax saving for that new car is only £37,500. So you've actually made quite a nice win out of going electric. If you decided you didn't want to buy it outright and you wanted to lease it instead, then what you do in that case is you put the monthly lease payments against your profit, and then you get the tax saving on the monthly lease payments instead. So you do still make a tax saving. It's just that obviously it looks more bigger to you if you'd bought the car outright. And your preference over whether you lease or buy, generally my thoughts on it is, if you like to renew your car regularly, then you may find it more beneficial to lease because you're in that scheme of renewing every 3 years or so. But if you're someone who likes to buy a car and keep it running, or assess the market as you're going along and maybe get a new one if you feel like it, and if you've got lots of cash built up in the company, you might prefer to buy one outright, but it's just down to preference. And in addition, you get 100% first year allowance on qualifying expenditure, which was ending in March 25. So what I'm talking about here is your charging points. So if you go electric, you'll need to get a charging point installed. Up to March 25, you'll get a tax relief at 100% in year one on the cost of that charging point too. So I mentioned corporation tax relief somewhere between the 19 and the 25%. It just depends what your profit levels are, as I mentioned, because of that sliding scale earlier. Next to mention is the benefit in kind rate on electric cars is 2%, which is very different to your gas guzzlers. It is increasing by 1% per annum over the next few years until we get to 5%. But it's still hugely cheaper. So I'm just going to skip forward a slide now and show you what I mean as an example. So if you were going diesel, or I've gone diesel because they're the most expensive, so it shows you the real differential. But if you bought a brand new diesel, so market value of £50,000, the benefit in kind tax rate on that is 35%. So your benefit in kind, which is the figure you're taxed on personally, it forms like your employment figure, is £17,500. So that's 50,000 times 35%. Now, if you're just a basic rate taxpayer, you'd pay 20% tax on that. And so personally, you'd pay £3,500 in personal tax. Whereas if you'd gone 100% electric for the same value of car, the benefit in kind rate is 2%. So your benefit in kind that's taxable on you personally is £1,000. Taxed at 20% means your tax payable is £200. Now, in addition to that, for a lot of company structures, we try to follow the small salary and dividend model for clients, which is where you take your total income up to the top of the basic rate band, which is £50,000. So if we've had to use 17.5 grand of that £50,000 available to you on the car, it means you've only got scope of £32,770 left to be able to take as dividend and salary. So much less personal income in your pocket as a result. Whereas if you've gone fully electric, because that amount taxed on you is only £1,000, you've still got scope of £49,270 left to be able to take as dividend or salary. So not only are you getting a whole load more cash in your pocket, you've not also got an outlay of a personal car because the company's paying for it all for you. So you can see where the wins of electric are coming. So if I just go back to my slide then, so I mentioned here the personal tax cost averages around £250 a year. I've just shown you that on that slide just there. And then just other points for you really is it creates a greener business image. So it's a great talking point with customers. People are impressed if you're thinking green. You've got a 0% benefit in kind on the electric charging too. So if you get a charger installed at the office, if you've got a business premises, anyone who's got an electric car can charge it and there is no benefit in kind cost. So you don't have to get the employees, for instance, to reimburse the electricity cost to save them some tax that they might be charged if you were to have to do a benefit in kind. It also makes an excellent perk for staff because, like somebody mentioned with the employee pension contribution earlier, if you want to get something more to your employees without causing them to go into much higher tax rates, if you got them electric car instead, they'd benefit from this taxable income figure being low on them as well. It's not just aimed at directors, it's aimed at anybody. So they'd have a nice electric car for very little personal tax cost too. And also, electric cars are allowed to be salary sacrificed when non-electric cars aren't. So what I mean here is if you had a diesel and the employee was on £100,000 and they said, I'll drop my salary to 95 and have my diesel, which costs you £3,000 a year, they'd still have to pay tax on the 100 grand because there's rules in place to say that that's what they should do. Whereas with an electric car, those rules aren't in place. So they could salary sacrifice and make a bit of a tax saving for themselves. So all perfect reasons as to why you should think electric cars. And I won't discuss the range of motoring and things like that because I'm not that good on electric cars in terms of which ones to choose. Okay, number 3, spouses and children. So what you can do is put family members with no income, because this is normally where it would work best, onto the payroll. So the reason for doing this is if they're not using their tax-free personal allowance, you can make use of it by giving them a salary. Now, before I explain this further, what you really need to be aware of is for salary payments to be made to family members, in order for them to qualify for an allowable tax deduction against your corporation tax or your income tax, they need to be performing services legitimately for the business and be paid at market rate for those services. So if you took on somebody on the payroll who's a family member, what you'd be saying to them is, well, could you be my PA or my admin support or do some bookkeeping or maybe a bit of marketing, something like that. Just a role where they can do a bit of work for you to justify the amount that you're paying them. So if you got to that point where you could justify the work, then as self-employed, what you would do is put them on the payroll, pay a salary to either your spouse or a child. That gets money to them tax-free. It reduces your taxable profit, so you pay less tax as well. So you've got more cash overall as a result. From a limited company perspective, it's the same difference. You put them on the payroll, but what it does instead is it reduces the profits, so reduces the corporation tax that you pay. And overall just means you get extra cash out, because as a director, you'd still take your set rate of say 50k, but you'd be getting additional 12 out to your wife, for example, tax-free if she'd had a salary. Now, with limited companies as well, there is an opportunity to put family members on the company as shareholders, but, and this is really important, if it's a solicitor's practice to be a shareholder, the shareholder must also be a practicing solicitor. And if they are not a practicing solicitor, then you would need to apply for the firm to become an ABS, which can be quite costly. So most of the time, solicitors' practice clients don't tend to have family members as shareholders at all, as I said, unless they're already a practicing solicitor themselves. Okay. So next, interest on directors' loan accounts. Now, a few years back, the rules were changed where you could get £1,000 interest allowance, so you didn't pay tax on your interest on the first £1,000. And also they brought in a £5,000 0% starting band, which generally you're not able to make use of, if you take quite a large salary or dividend model. But where you're a director of a company and the company might owe you a lot of money on your director's loan account, there's an opportunity to charge the company interest on that loan account, and it enables you to extract some tax-free cash, because essentially what you would do is swap your taxed dividends for tax-free interest. And it only really works if you've got a loan account of around £40,000 plus. So what you would do is you'd say, the company owes me £40,000. I'm going to charge it 10% per annum interest. So that would be around £4,000. And then what you would have is that £4,000 falls in that interest allowance and starting band. It falls within there, so there's no tax due on you personally on drawing that money out. Whereas if you'd have drawn £4,000 out of dividends, you'd pay dividend tax on it. So you're making a tax win. The only thing to be aware of is that in order to do this, you must complete something called a Form CT61 and send it to HMRC. You can do these quarterly, or you can choose to do it annually. It's your preference, and they aren't complicated. So you could do it yourself internally, or if you didn't want to, you could ask your accountant to do it for you, but just be aware they might charge extra to do that service. Somebody just asked a question. I thought the limit for direct loan accounts is 10k. You spoke about 40k in your example. So that 10k, what you're thinking of is if you have an overdrawn director's loan account, if it's more than £10,000, you have to charge interest on it. So the company will charge you interest for loaning you money. That's a HMRC benefit in kind rule. So if you owe the company money back, once it's over £10,000, you must pay interest. So it's like the complete opposite to what we're talking about here. Okay. Next slide. So this one, timing of capital purchases, is not a tax saving as such. It's more about managing your cash flow in order to help with those tax savings. So there's something in place called an annual investment allowance, and it's £1 million. And what that means is you can buy capital items for the business and you'll get 100% tax relief in year one on the first £1 million. So an example would be if you were a printer and you bought a printing press, you'd get 100% tax relief in that press in year one, or company vans or your electric cars, as I mentioned earlier. Now, like I said, it's not an actual tax saving, it's about the timing. So if you bought that equipment really close to your company year end, so I'll choose 31st of March because it's where self-employed and companies fall most in line. So if your year ends 31st of March and you bought that capital equipment in March, you'll get the tax relief by way of deduction off of your profits to the 31st of March. And then when you pay your tax for both companies and self-employed, it's either the 1st of January or the 31st of January the following year, so roughly 9 months after the year end. So if you bought it in March and then you pay the tax in the January, you've only got a 9-month gap where you've lost out on cash flow. Whereas if you bought it in April, you'd have to wait right till your next company year end and then wait for the tax relief to kick in when you make the payment of the tax 9 months after that. So it's not a year and 9 months before you feel the benefit of that tax saving. So it's just about timing. That's all this is. So for companies, your capital expenditure, you'll get tax relief somewhere between 19 and 25%, depending on your profit levels. For self-employed people, again, it's a deduction from the profit. So you'll get somewhere between 20% and 45% tax relief, depending on your profit levels. For solicitors, you might be thinking, well, what's my capital expenditure then? What I'm talking about here for you guys is if you buy computer equipment, if you replace your server, that might be a bit of expense for you guys. You could spend £8,000 on replacing the server. If you do that in March, you'll feel the benefit of that tax saving quicker. Okay. Right, trivial benefits. So these are for all employees, including directors. Now, the first that you can give an employee £50 or less, including VAT, of gift. Now, that gift cannot be cash or a cash voucher. So gift cards are okay as long as they can't be convertible to cash. So they might come to you and say, oh, I'd quite like some vouchers for a particular shop that they want to go shopping in. Could I have it for there, please? That's fine, you can go and do that. Now, these £50 trivial benefits, they shouldn't be a reward for work or performance. They should just be a gift for, you seem like you've done really well this month, so here, have some money, have a £50 trivial benefit voucher, or the business has done particularly well, we feel like we want to treat all the employees, have a £50 voucher each, or Merry Christmas, have a £50 voucher each. The point is, it's not for performance and it isn't part of their contract, so there should be no expectation to receive it. It also applies to directors, but directors are limited to a maximum of £300 worth in the year, whereas other employees, you can do it as often as you like. But if you're thinking about business owners, as a director, it's a way of getting £300 a year out to you tax-free by way of trivial benefits. Somebody's asked a question, is the trivial benefit in addition to, say, paying for their Christmas party? Yes, it is an addition. So Christmas parties, you're allowed £150 per head per employee, including VAT again. If they bring their spouses, that's doubled. So if you have a Christmas party where partners come along, essentially it's £300 per employee you can spend before it becomes a benefit in kind. Okay, so rental income splits. So the scenario here, somebody's just asked the question. I want to refer back to it so that you don't get confused later on. Someone said, would gym membership count too? Now, gym membership would be a benefit in kind because you would be paying it every single month as a fixed outgoing for them. So it would be like it becomes contractual. Whereas if you just decided 1 month because they were paying it as they were going along, or you wanted to encourage them to go to the gym for one time, then you could say, here you go, I've just paid for a month's gym for you. Well, enjoy it. So you've got to be careful what kind of things you're picking for your employees. Okay. So I'll just go back to rental accounts then. So on rental income splits, what you might have is a married couple, one spouse might have a really high income and one spouse might have a really low income. So the basic rate band for that low income spouse is currently being wasted, and the other spouse is paying probably 40% tax on that rental income, where because their other income is so high. So what you could think about doing is changing the ownership weighting so that the rental income is weighed more towards that low income spouse. So it's taxed at a lower rate. Now, there's important things you need to know about doing this. The first thing is the property must be owned as tenants in common. If it's a joint tenancy, you cannot change that split. The only way you could consider changing that split is if you sever the joint tenancy. So yeah, it's really important. It must be tenants in common. And then if it is tenants in common, what you could do is say, well, I'd like my spouse to have 90% of the rental profits and I'll have 10%. But what you also need to be aware of is by doing that, it also applies to the capital. So if you sell that property later down the line, that spouse that's got the 90% would also be entitled to 90% of the proceeds, and they'd have to declare tax on 90%. So that's just a point to note. Now, with capital gains tax rates, you know, the annual allowance that you got, with that dropping from 12 grand down to 6 and then down to 3 grand, you might say, well, that's not such a big deal now because I'm not losing out on that capital gains tax annual exemption, but it's just something to bear in mind. The other thing that you need to bear in mind is that in order for this to apply, you have to tell HMRC in advance by something called a Form 17. So you submit the Form 17 and tell them what percentage you want to be able to show the property split as. And normally HMRC wants some sort of proof to go with it. So a lot of our clients would do a trust deed to go with the change in ownership to say that I'm putting my 50% into my wife's name, essentially. So it's just bear in mind that you'd need to do a trust deed as well. There we go. Next one is the marriage allowance. So this is quite a simple one. So if you've got one spouse who's not making use of their tax-free personal allowance, which is currently £12,570, if they've not got any income to go against that, there is an opportunity to submit a request to HMRC to transfer £1,260 of that personal allowance to the spouse that does have taxable income. And what that will do is reduce their own tax by £252. But please note, it's not available for higher rate taxpayers, so only basic rate taxpayers can do this. Okay, the next one's a little more complicated. So some of you might decide to zone out at this point, and I'll try and keep it as brief as possible. So EIS and VCTs, these are generally aimed at people that are really high earners or have lots of excess cash, and they're looking at ways where they can get rid of some of the cash and save some tax. Now, EIS and VCTs are all approved by HMRC. It's important to know that because I'll mention it again later. So they are designed by government to help finance small companies to grow. So what they do is they encourage taxpayers to invest in companies because they carry associated tax reliefs. So this is where it makes a tax saving for you. So there are rules surrounding them, and you will most likely want to use a financial advisor in order to help you source the schemes and also diversify your portfolio in order to reduce that risk, because they do carry risk, because there's no guarantee that the business you invested in will succeed to enable you to receive return on your investment later down the line. So the benefit to you is that you can reduce your tax liability by a maximum of 50% of the amount you invest, depending on which version of them you choose. Because as you can see, there's EIS, SCIS, SITR, VCT. They all follow the same sort of principle, but they've just got slightly different rules to them. So yeah, the maximum you can get is 50% tax relief on the amount you invest. And then as long as you keep the investment in for at least 3 years or 5 years for VCT, once you sell those shares on, you'll pay no capital gains tax on the sale of the shares. So as a long-term plan, you're getting tax-free cash basically. So another example of where you might find this useful, rather than just thinking about your income tax position, is if you've got an asset that you're planning to sell, which is going to create a large capital gain. So what I mean here is an example is you might have bought a property 25 years ago and bought it for, say, I don't know, £50,000. And now, because prices in properties have increased so much, it might be worth £800,000. So you're going to make a massive capital gain on selling it. So what you could consider doing is investing in one of the ones there. So you can do everyone except a VCT, and what it does is it defers the gain on the sale of the asset. So you can put some money into an EIS and defer that capital gains tax that's due, for example. So the investment in all of them except the VCT must be done at least 1 year before you sell the asset or 3 years after. So if I call the asset a property, just to make sure you're all understanding, you sell the property in 2025, you could need to invest in an EIS, for instance, in 2024 or up to 2028 in order to defer that capital gains tax. So yeah, 1 year before, 3 years after, you'll need to pay the tax. So that deferred capital gains tax, you'll need to pay it when you dispose of the investment, or if the investment's cancelled or redeemed or paid. So for instance, if you put into an EIS and then that scheme went under less than 2 years later, then it didn't fulfill the requirements of the rules. So therefore that deferred capital gains tax becomes due. It also happens if the company you've invested in stops meeting the conditions, or if you become non-resident. So all of these, as I said, are HMRC approved, and these were the only ones I would suggest. There's other things out there, for instance, film partnerships, where they follow similar principles, but those aren't HMRC approved, and they all run the risk of being investigated by HMRC. So any tax relief you might have benefited from would be reversed. And you could also have penalties applicable. Because of what they are, HMRC are quite rigorous with their penalty regime. So they could be 100% penalties of the amount of the tax as well. So by going for an unapproved version of any of this, you can really get yourself into deep water. So these would be the only ones I would recommend if you're considering this sort of idea. Okay, my last one, number 10, is to have a good accountant, because all of the things that I've mentioned in these last few slides, any good accountant should just do this day to day for you. And if it's not been thought about or not spoken to you about, then they're, in my opinion, not doing their job good enough. So that would be my best tip of all of these. Have a good accountant. Get them to talk to you about how much you should, for instance, put into pension, or how much electric cars would cost and how much tax you would save in comparison if you were to go for one. They should be running those sorts of numbers for you as you're going along. And if you don't have an accountant that's doing that for you, then please feel free to talk to me. We offer a free, no obligation meeting where we can tell you what we can do for your business and also where some tax saving opportunities could arise. So my details are on this slide just here. And if you do want to have a chat with me, please do get in touch. There are a couple more questions that have come up while I carried on talking, so I'll just refer back to those before I finish off, okay? So somebody's asked, could you just clarify again what is the maximum per employee in trivial benefits per annum, such as a gift card? So if it's an employee, you can do it as many times as you like for a trivial benefit, as long as the amount you give them each time is not more than £50. If you are a director of a company, the maximum you can do it is up to a value of £300 for the whole year. But again, it must still be £50 a time. I hope that clarifies it for you. But again, if you've got any more questions on it, please do feel free to drop me an email. Okay, I can't see that any more questions have come up, so I think we'll end there.
Thank you, Paula. Thank you for that presentation. I think everyone definitely took something away from that they can apply. So yeah, that's really useful. As a reminder to everybody, the slides and a recording of the webinar will be sent over tomorrow. This afternoon, you should receive an email as well asking you to rate the webinar out of 5 stars. And if you have enjoyed the webinar today, please do leave feedback and any suggestions for future webinar topics. Our series of webinars continues on Wednesday, the 8th of November, and that will be part of the Managing for Success series. It will be how to manage people and change. And that will be delivered by DG Legal's own Sarah Charlton and James Wright. And unless you have anything else to add, Paula, that's
No, thank you.
That's all we have today. So thank you again. Thank you to everyone for attending and have a great afternoon.
Thank you all for listening. Bye.